Reporting season's here again, so let's take a look at some interesting ASX small caps. The team here at A Rich Life are following these three closely: an attractively priced income play, a retailer aiming to turn its fortunes around, and an under-the-radar stock trading on a single-digit PE. These companies are all at pivotal moments in their journey, so let's break down what's happening and what to watch for in the weeks and months ahead. Number 1, Fiducian Group. Fiducian Group is a diversified financial services company offering financial advice, asset management, and an investment platform. It's delivered steady growth in recent years, and their latest results continued this trend. Revenue jumped 14% to 44.3 million, while net profit after tax surged 26% to 8.6 million. Claude Walker, editor-in-chief here at A Rich Life, has been following Fiducian closely. He points out that the funds management segment was the standout performer in this half, benefiting from strong inflows. However, their investment platform business wasn't as strong as expected. Historically, the second half tends to be better, so there's still a chance for a record full-year result. One thing to note is that Fiducian's success is heavily tied to overall market conditions. As Claude puts it, these are relatively good times for Fiducian, but if market momentum reverses, the stock could take a hit. On the valuation front, Fiducian isn't as cheap as when we originally recommended it, but it's still an attractive dividend stock. The company has a strong balance sheet with 28.9 million in net cash and no debt. That makes it a solid defensive play for income-focused investors. Fiducian reported results on Monday, the 17th of February, and it rallied 9.84% on the day. Number 2, Adore Beauty. Adore Beauty has long been known as an online beauty retailer, but they're making a major shift into physical stores. Their first store opened earlier this year, and they have ambitious plans to roll out 25 more by 2027. Now, their latest results were a bit of a mixed bag. Revenue growth was a disappointing 2.3% year-on-year, but that's partly because they've been cutting unprofitable product lines and dialing back on discounts. On the flip side, their gross margins hit a record 36.2%, up an impressive 2.7 percentage points. So, a big win on profitability. One of the biggest unknowns is how well their acquisition of ICO is performing. Management has declined to break out separate financials, making it hard to assess its true impact. But by my rough estimates, ICO added around 3.4 million in revenue and around 840,000 in EBITDA over 5 months. But without more transparency, really we're just guessing. Looking ahead, the key question is whether they can continue to expand margins while also accelerating revenue growth. If they pull it off, the stock could become a lot more attractive to investors. Execution of the store rollout will be another big thing to watch over the next few years, so it'll be worth keeping an eye on cash flows to ensure that they're able to fund it without taking in fresh capital. Adore also reported its half-year results this past Monday, with the stock price falling 3.03% on the day. Number 3, Centrepoint Alliance. Centrepoint Alliance is one of the largest financial advisor networks in Australia, sitting just behind AMP and Account Financial. The company has been growing both organically and through acquisitions, adding 39 advisors last year at a time when many competitors were actually losing them. Chris Coe recently took a position in Centrepoint and highlighted some of the key growth drivers. The company has been diversifying its revenue streams, including acquiring Financial Advice Matters to grow its higher margin salaried advice business. They also launched a new investment platform, IconiQ, which could be a game changer if it gains traction. On the financial side, Centrepoint has delivered 4 straight years of revenue growth, with net revenue up 6% last year and profit after tax jumping 24%. The trailing 12-month dividend yield is a juicy 12.5% grossed up for franking credits, making it one of the more attractive small-cap income stocks. The big risk here is competition. The financial services sector is crowded, and Centrepoint is up against some big players. In particular, with their platform business, which is competing with products from the CBA-backed Colonial, Westpac-backed BT, AMP, Netwealth, and Hub24, among others. Platform fees could come under pressure, and there's always a risk that acquisitions don't work out as planned. But given it's trading on a PE ratio of just 9 times, and it's generating strong cash flow, it could be an under-the-radar opportunity. Centrepoint Alliance will release its half-year results this coming Monday, the 24th of February. Our full write-ups for these 3 stocks are available for free at A Rich Life with links in the description below. So, which of these do you think has the most potential? Let us know in the comments, and don't forget to like, subscribe, and hit the notification bell so that you don't miss any of our future updates. See you next time.